Hello, my name is Jeffrey Smith. I'm the Chief Instructor here at DTI. I want to talk about bond futures and bond options on futures. Of course, there is risk in trading. Past performance is not indicative of future results. You can lose money, and before you enter into any trade, always evaluate the risk before entering it, because if you cannot afford the risk, do not take the trade. Talk about the 30-year bond futures. This contract actually is a commodity. It controls a $100,000 30-year U.S. Treasury bond. And when we start looking at the bond futures, it trades 23 hours a day electronically. It's traded through the CME on a computer system called Globex, stands for Global Exchange. They also trade open outcry pit, but most people are used to clicking on a mouse, so we'll be just talking about the electronic contract. Its tick size, or the smallest increment, is actually in 30 seconds. It's traded in 1/30 seconds of a point, and of course every tick is worth $31.25. So 32 over 32 is 1 point, so for every point it's $1,000. The trading hours start out at 5 p.m. Central Time, and it ends at 4 p.m. Central Time the next day. So like I said, it's 23 hours, just about 24 hours long. The symbol is Z as in Zulu, B as in Bravo. You will see on some quote pages, they will quote it as US. U as in uniform, S as in Sierra. But the actual symbol itself is ZB. And of course, it is a commodity that can be assigned. Its contract months are H, which is for March, M, which is for June, U, which is for September, and Z, which is December. However, its first notice date, the date at which you can start being assigned if you're long the contract, is the business day prior to the month of expiration. So if you're looking at the December contract that you're trading, the last business day of November is going to be first notice date. So if you're long on first notice date, you can be assigned. So beware of that date always when trading bond futures. As long as you're out before that date, you will not be assigned the commodity. So in any commodity, in fact, not just the 30-year bonds here, always beware of first notice date. That way you won't be assigned the commodity. I mean, there's nothing like getting 5,000 bushels of corn being delivered to you. So do beware of that. So quick trade example here. If you buy one contract at 130.19, now the 130 is the number of points above par. Par is 100. The 19 is in 19/30 seconds. And you got out at 131. Now remember, 1 point is 32/30 seconds. Okay, so from 19 to, or 130.19 to 131 would be 13 ticks, because you have 32 minus 19 basically, which is a total of 13 ticks. And of course, in the same day, if you sold the contract at 129.24 and got out at 128 even, then that'd be 24 ticks total. So if you add the 13 and the 24, you get 37 ticks. And if you multiply that times $31.25, then you'll end up with $1,156.25. So you can get paid quite a bit in bonds. Now this is a big contract. There's no mini contract in the bond futures. The 30-year Treasury bond options are also traded at the CME on Globex. They're traded open outcry pit and electronic, but again, we'll be just looking at the electronic contract. They're traded in 64ths of a point, as opposed to the actual futures that trade in 30 seconds. Each tick, half of 1/32, which was $31.25, is actually $15.62.5 per tick. The trading hours are the exact same. The futures are traded between 5 p.m. and 4 p.m. the next day, 23 hours. And as long as the futures contract is open and trading, the bond options will be open and trading as well. The symbol for the bond options If you recall from the actual Treasury bond, we were using ZB. Well, they'll stick an O in front of it for OZB. The O is for option, ZB is the underlying futures contract. So if you have the OZB Z3 C130, this would be the O is for the option, ZB is the underlying, which is the 30-year U.S. Treasury bond. The Z and then the month here is the Z is for December, 3 is for the year 2013, C is for call, and the strike is 130. So this would be a December 30-year bond 130 call. So, but all the option symbols actually are on the actual contract when you put a C or a P right here for call or put in the strike price. So it's pretty simple to remember the symbols for the options when it comes to futures contracts. Again, an example, if we sell to open an August bond 136 call at 7 ticks, so we bring in 7 ticks from now. Remember, this is in 64ths. So 7 ticks times the $15.62.5 is $109.37 per contract. So, which is 7 times your 1562.5. If you're looking for about 25% of premium, or 1 to 2 ticks in this case, just because of the 7 ticks that we're bringing in, or if you're looking for full premium at expiration, if you get 1 tick, or 1 tick which nets about 6 ticks, or $93.75. So if you're buying it back, then, of course, at 2 ticks, you're going to net right around 5 ticks or so, which if you take 7 minus the 1, there's 6 ticks left, okay? And then if you're looking at 7 minus the 2, there's 5 ticks left, or $78.25. So you're bringing in the $109.37. You're having to buy it back at either $93 or at $78.125. So full premium would be the full 7 ticks, or the $109.37.5 per contract. If you risk 2 to 3 times the premium received, 2 times the premium be 2 times 109, which would be, the 7 minus. If you look at 3 times the premium, it'd be about $218. So depending on what your risk is, in other words, if it starts going against you, right? You sell it for 7 ticks, but say it goes to 14. Well, you're going to lose the $109.37.5 because you brought in $109.37.5. So now we're going to have to buy it back. It's if it doubles. If it triples, we'll actually lose 14 ticks. In other words, it's going to be at 21 ticks. So we'll lose $218.75. Each point on the bond, of course, is $31.25, and on the bond options is $15.62.5. So that is just a very quick overview of the bond futures and the options on bond futures. Thank you.